Welcome to Stock Trading Ninja Part 2, Popular Technical Analysis Indicators. I'm your instructor, Frank Bunn. In this segment, we're going to be looking at just that, technical analysis indicators. If they work, then why isn't everyone rich? But more importantly, you're going to learn some critical information about how the action of price itself is paramount and randomly cooperates or doesn't with technical analysis indicators. And you're going to learn one seldom discussed truth about randomness that will change the way you look at trading. In this screenshot example, we see the popular Moving Average Convergence Divergence Indicator, or MACD for short, on a daily interval chart of Capital One Financial. We can see how the indicator itself oscillates around a moving average of itself. These crossovers, by conventional wisdom and according to the fine folks at Investopedia, are buy and sell signals. More on this in just a minute, but first, let's observe an 8-month time and data series of Capital One with the indicator plotted below the price. And follow me on a little experiment. If we had traded the typical signal line crossovers we saw in the previous example, let's take a look at how well this indicator would have performed. Quite simply, using the red signal line crossover to buy and sell, we have 4 generic long trades and 3 short trades. Let's analyze this. For longs, we have 3 wins and 1 loss, and for shorts, we have 1 win and 2 losses, for a total long-short performance of 4 wins and 3 losses. Here's another widely followed indicator, the Directional Movement Index, also a crossover-based trend-following indicator, plotted on the same time and data series of Capital One Financial we saw previously. We can see how trades are conventionally triggered when the green line crosses above or below the red line, supposedly indicating a change in trend based on the indicator logic. So follow me again through the same analysis of that 8-month period on the Capital One daily interval chart, using the directional movement crossover signals this time. Let's see how it works. We have 5 long trades and 4 short trades this time, 2 more than generated by the MACD indicator. Closer analysis reveals the longs produced 3 wins and 2 losses randomly, and the short signals performed quite miserably with 1 win and 3 losses, for an overall total long-short performance of 4 wins and 5 losses. So what's going on here? Well, let's draw some random conclusions. It would appear that similar market conditions may produce radically disparate results in different indicators of the same species, in this case, trend-following indicators, and that many, in the latter case, too many false signals may be randomly generated. More importantly, we see streaks of profitable signals when the market trend cooperates, as in the first MACD example with the long trades where there were 3 wins and 1 loss as Capital One trended higher during the period. Upon even closer analysis, we see that some signals are right on time in conjunction with the price action, while other triggers are hopelessly late or behind the curve. And lastly, and most obviously, exit signals are either on time, early, or randomly absurdly late. With outcomes so random, why would anybody really bother? No wonder technical analysis gets a bad name. Well, first we have to learn the technical analysis golden rule. That is, the price action following an indicator signal is random and not determined by the indicator signal itself. Okay, this certainly makes sense. So a technical analysis signal is really nothing more than an edge, like an edge in a casino game or a card game, we hope. Just the potential greater probability of one thing happening over another. It seems to fit with what we just learned about random outcomes in the golden rule. So let's keep going. Keeping in mind that technical triggers always produce random outcomes, we now must consider the notion of trends. So here's the stock trading ninja truth of the trend. An established trend in price is statistically more likely to continue from one interval to the next than it is to reverse. And this is really interesting. So according to empirical and statistical analysis, a trend in price once begun should not finish till it's done. And this opposes the technical analysis golden rule. So when we observe the first chart of Capital One again, we could see randomly generated MACD signals within the clear long-term uptrend in Capital One. Overall, the indicator performed rather poorly, But if you had some basis for determining the trend of Capital One as up any time during that 8-month period on any given day, you would have been correct, as the price meandered higher throughout the entire interval. Fascinating, and more on this in just a minute. But it seems like we can trust the trend if we can determine it. But indicator signals themselves have a tendency to produce marginal results. Why? Well, it's a good question. Let's check it out. First, most technical analysis indicators calculate an average of recent prices, such as highs, lows, or closing prices. And any attempt to smooth market action by averaging price will randomly cause indicator output to lag current market action. In plain English, we have late signals. Okay, this makes sense. And right back to the golden rule. And third, any price action following a signal trigger is completely random, giving the empirical notion that an established trend is more likely to continue than reverse. It is really important that you understand the distinction as well as embrace the notion of randomness in short-term price movement juxtaposed to the tendency of trends to continue from one interval to the next. So how do we make this work? Well, what if indicator output will randomly lead market action? Doesn't it stand to reason that if an indicator will randomly fail, then it will also randomly be right on time? And that random technical analysis signals produce outstanding results, which we have seen in some of the examples above. And so, if market action following a signal is random, you will randomly be handed huge winners by the market, which is an empirical truth. And here is the kicker. Risk control games avail the trader to massive winners without unnecessary risk. So we're going to learn how to exploit random outcomes and use them to our best benefit with what's called a risk game. More on that in upcoming segments. But first, let's discover the truth, which is in the price action of the market itself. And so we know that indicator signals will randomly cooperate with price action. And I'm going to show you exactly how to determine which ones. But more importantly, this price action can be read and interpreted with alarming accuracy because it doesn't lag the market. So what exactly will we be doing? Well, we're going to use the indicator signal as the impulse for the trade, and we'll learn all about this when we cover the trend flow objective in the coming videos. And basically, we won't ever be trading the signal itself, but rather we'll be trading the most probable reaction within this trend flow that we're going to learn. And as you'll see, it is really easy, and it also can be spotted everywhere the price is trending. How cool is that? So we're combining the power of random technical analysis signals that are right on time with the awesome power of an established trend in price, which, as you know, is more likely to continue than it is to reverse. Sounds exciting, doesn't it? Well, it really is. And we'll get to it as soon as we learn all about the tools we'll be using. So see you in the next segment.